to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Gleason. Coming up, we'll hear from renowned author, market commentator, and founder of Grant's Interest Rate Observer, Jim Grant. Jim tells us why he believes the current low interest rate environment is unsustainable and how it is pointing to what he believes will be a years-long bear market in bonds after we've seen a multi-decade bull market in the sector. Jim also explains why he believes inflation is not under control, despite what we're hearing from Fed officials and other talking heads in the financial industry. So be sure to stick around for another wonderful Money Metals exclusive interview, this time with the well-known Jim Grant, coming up after this week's market update. Gold and silver have pulled back several percent over the past week, while stock markets have been buoyant over the past week as the Trump administration has softened its stance on tariffs. At the same time, though, uncertainty about corporate earnings are keeping traders alert. Earnings reports released over the next few days will reveal whether sales and margins held up during the chaotic first quarter of 2025. For the week, gold is off a little more than $80 or 2.6% to come in at $3,246 an ounce. Silver's down close to $1 and checks in at $32.32 an ounce, registering a weekly decline of 2.9%. The PGMs are somewhat mixed on the week, with both platinum and palladium currently on par with each other and checking in at $981 each. That results in a 1.4% weekly decline for platinum and a 0.5% gain for palladium. Even though Americans still don't seem too interested in buying gold, that's certainly not the case in Asia or with central banks, with both having continued stockpiling gold in the first quarter. As the World Gold Council put it, central bank gold buying remained, quote, comfortably within the quarterly range of the last 3 years. Official central bank gold demand topped 1,000 tons for the third straight year in 2024. And as Money Metals has reported in the past, there is strong evidence that a few central banks hold far more gold than they report. So what countries are buying gold? Well, the National Bank of Poland was the biggest central bank gold buyer in 2024 and stayed number one with continued purchases through the first 3 months of 2025, adding another 49 tons. Last year, National Bank of Poland Governor Adam Glapiński indicated the central bank plans to increase its gold holdings to 20% of its reserves, pointing out that this strategy makes Poland a more credible country with better financial standing across the world. Gold is free from credit risk and cannot be devalued by any country's policies, Glapiński noted. The People's Bank of China publicly returned to the table in November after a 6-month pause in reporting its gold purchases. The Chinese central bank was the second biggest buyer in Q1, adding another 13 tons of gold to its official reserves. That pushed its official gold holdings to 2,292 tons, about 6.5% of its total reserves. Notice the emphasis on official. China is one of the central banks that likely holds significantly more gold than it publicly discloses. And as our own Jan Nieuwenhuis has reported, the People's Bank of China is secretly buying large amounts of gold off the books. According to data parsed by Money Metals, the Chinese central bank is currently sitting on more than 5,000 tons of monetary gold located in Beijing, more than twice what has been publicly admitted. The National Bank of Kazakhstan added a net 6 tons of gold in Q1, despite selling 8 tons in February. The Kazakh central bank pivoted back to buying in March, adding 11 tons to its holdings. That pushed its official gold reserves to 291 tons. The Czech National Bank has been slowly building its gold reserves for the last several years. The Czechs added another 5 tons of gold to their holdings in the first quarter. That pushed its total gold reserves to 56 tons, 4 times higher than it was at the end of 2021. After ranking as the third biggest buyer in 2024, the Reserve Bank of India continued adding to its gold reserves in Q1, but at a much slower pace than before. Other notable buyers in the first quarter included Turkey, Qatar, Egypt, and Azerbaijan. On the other hand, Russia sold a small amount of gold. This strong central bank gold buying continues a trend we've seen over the last 3 years. On net, central banks officially increased their gold holdings by 1,044.6 tons in 2024. It was the 15th consecutive year of expanding gold reserves. Looking at the broader perspective, the central bank gold buying trend is now entering its 16th year. The World Gold Council expects the trend to continue, noting that diversification with a reduction of U.S. assets is one of the factors driving central bank gold buying. In other words, de-dollarization. Even as the U.S. government and the Federal Reserve continue on a dangerous fiscal and monetary path, Americans can go on their own personal gold standard, and there's no better company to help with that than Money Metals. This is especially true because premiums on coins, bars, and rounds remain at multi-year lows, allowing customers to acquire the monetary metals in a highly efficient manner. Meanwhile, Mother's Day is coming up, and we want to remind our customers about Money Metals' wide selection of bullion investment jewelry. In our opinion, this is the only way to buy jewelry because these gold and platinum bullion pieces are priced mostly based on their actual metal content. Please visit moneymetals.com and see how we can help make this Mother's Day an extra special occasion for the mother in your life. Well, now, without further delay, let's get right to this week's exclusive interview.
Greetings, I'm Mike Meharry, a reporter and analyst here at Money Metals, and I'm thrilled today to be joined by Jim Grant. He's a longtime market observer and a commentator and the founder and publisher of Grant's Interest Rate Observer, and honestly, one of my favorite commentators, and I'm trying not to fanboy too much about having him on the show
Go ahead,
today.
Michael.
How are you doing?
Good, thank you.
Great. Well, it's a real pleasure, and I want to start off with this. President Trump has been pushing for interest rate cuts, and I can understand why. But on the other hand, I think you could also argue that the Fed needs to hold interest rates higher because I'm not convinced that the inflation situation is really as under control as they would have us believe. So what is a Fed person to do in a situation like this? It's almost like they're in a catch-22, isn't it?
Right, they should resign. That's what they should do.
Okay, that's
Well, they rather brought this on themselves. Inflation is after all these years after Adam Smith. It's rather a mystery, isn't it?
yeah.
The doctors of economics are dogmatic, each of them in his or her own diagnosis of the cause. But there's no really one accepted model. It has to do with the complexity and inherent unpredictability of human action and behavior. But I find it fascinating and, of course, quite humbling that Milton Friedman, as brilliant as he was, inflation is always everywhere, a monetary phenomenon. And John Cochrane, contemporary of ours, no less brilliant, I think. Inflation, approximately, I'm quoting John, I'm paraphrasing him. Inflation is always and everywhere a fiscal phenomenon, right? And the Fed is approximately saying, or has approximately said, that inflation is always and everywhere a phenomenon of public expectations, right? So it's like the physicists can't agree on gravity. What's gravity? The Fed is holding its funds rate at above 4% at the time when the market is pushing the 2-year note yield below 3%, or around, certainly lower than the federal funds rate, which leads some, including the Treasury Secretary, to say that, well, the market wants a interest rate cut, and yet the brain boxes at the Fed are unconvinced that inflation is under control. So I am, for once, with the brain boxes at the Fed. I don't think inflation is under control. I think that everything around us is pointing, in general, to, if not more inflation immediately, certainly not a great deal less. And I've come to think here that there's only one thing in the whole panoply of human actions that is certainly inflationary, and that is war.
True.
Because it sets, it brings forth money printing, it brings forth borrowing, and it sets inflation expectations higher because the demand for goods and services is greater than supply by definition, and we're in the process of destroying this excess supply. Okay, so would it surprise anyone, Michael, if the Chinese made a move to blockade either Taiwan or one of the outlying contested islands, say tomorrow morning? So I think that the risks of inflation, whether it be from geopolitics or the much discussed effects or secondary effects of the tariffs, and I think the inflation picture certainly is. I think it points to more inflation, but certainly it is not settled. And I think Jay Powell wants it to be settled insofar as he can settle it.
I've noted that the money supply has been increasing again almost for a year now. I think it started basically last summer. And, it did come down some during the early days of the cuts. But wouldn't that seem to indicate that that is by definition inflation, right? When you see the money supply increasing.
Yes. So that is a very respectable definition of inflation. And there's also the question of whether the symptoms of inflation don't reside as much in financial and speculative markets as they do in the measured rate CPI and core CPI, core PCE, what have you. Mm-hmm. As crypto is elevated as is that inflationary thing? There's a German mid-20th century economist called Wilhelm Ripke, one of my favorites. And he said that inflation is the overstraining of the economy's productive apparatus. That strikes me as an appealing description of what goes on.
Absolutely.
Although you don't see overstraining in the capacity utilization measures. So you can talk yourself to death about this, and I will stop talking myself to death. But I think we are inherently an inflationary cycle. It's insofar as something for nothing is a ruling sociological meme, which I dare say, and political meme. I think that is an undercurrent of persistent inflation. Something for nothing.
Yeah. You've been watching interest rates for a very, very long time.
Yes, I was there at their invention.
I don't think you were quite there then, but it is interesting. And so I'm gonna throw this question at you, and it's a little bit of a loaded question. You'll probably pick up on it, but they talk about normalizing interest rates. What is normal?
6%. 6% is a normal American interest rate. It goes back to Alexander Hamilton. He was trying to and succeeding in consolidating the Revolutionary War era debts. The U.S. was paying 6%. That was the start of things, 6%, and Europe was at 3 or 4. And I'm talking now about a kind of imagined composite of strong investment grade, if not AAA rated corporate debt, investment grade railroad debt, the measured, the historical record is broken at times by the nature of the obligor, or the debtor. But 5 or 6% is the rate. I got in the journalism business. Well, I got my first job when I got to the Navy at the age of 20. For a while I was a clerk at a bond desk in Wall Street, McDonnell and Company. And I remember so well the 4.25 of 92 was the benchmark security at the time, and then along came all these Great Society and what have you, and pretty soon it was 5% and 6%.
Mm-hmm.
I telling my father he had to buy the New York Telephone sixes, 30-year sixes, because we wouldn't see that interest rate for a long, long time. I got this by eavesdropping on the sales force in Don Allen Company. And it's true, we didn't see 6% for a long time, but we didn't see it because the rate was then 7%, 8%, 9%. And finally in 1981, like a dozen years after I'd been eavesdropping on the salesman to get the skinny on interest rates, the long-dated Treasury tops out at 15%.
Mm-hmm.
So, and then, wouldn't you know it, there's a 35-year bond bear market, 1946 to 81, and then comes what I dare say few expected, which was a 40-year bull market in bonds, finally arriving at the destination of zero or less than zero. And I'm telling you, Michael, that very few, having survived until the days of 15% in 1981, would have answered the question correctly. In your career or your son's or daughter's career, will you or they live to see $18 trillion worth of bonds worldwide priced to yield less than nothing? And I think most everyone has said, no.
Right. Are you insane?
Get off it. But it happened. It's very humbling, isn't it? It shows you. Remember Richard Russell, the dear, great Richard Russell would say, markets can do anything. I think that's so important for us all. As we speak, the gold market is doing not what we want it to do. But markets can do the remember there's a TV show, I think it was an Art Linklater. Kids can do the darndest things.
I do remember that, yes.
and so can grown-ups.
Markets.
And especially can leverage grown-ups and markets do the darndest things.
Well, speaking of those cyclical cycles, I've heard you on numerous occasions say that you think that we are likely in the early stages of a bear market in bonds. And I would love for you to explain to the audience why that you've come to that conclusion.
Yeah, I'll be happy to try. The bond market is unusual in that it has exhibited since the middle of the 19th century, just after the Civil War, a tendency to rise and fall as interest rates to rise and fall at generation length intervals. Mm-hmm. So it's down and up, but over the course not of months or fiscal quarters or a handful of years, but for 20 and 30 years. Interest rates fell for most of the last 30 years of the 1800s, and they rose in the first 20 years of the 20th century, 1900s. That took us to 1921 or so, and they fell pretty much till 1946. They were suppressed during World War II. But those are, if you look at those are all 25 or 20-year cycles. Mm-hmm. And then comes the 1946 to 1981 affair, that great bear market in bonds, which landed us at improbable heights. I mean, utility, good, decent quality utilities were paying 20%, and bonds with call protection were priced. I remember this very well. Were priced almost at a par with bonds without call protection. Such was the settled view that rates would never fall again. Mm-hmm. And mind you, these are professional bond people talking here,
right?
Because we all get conditioned, right? We all get conditioned by experience, and it's the great teacher and the great confounder. So that 1946 to 81 affair went from the depths of 2.25 to the heights of 15. Again, only looking at long treasuries, and then comes this persistent money-making. Wind in your sails, bull market in bonds, a drop in interest rates. I think I'm trying to think of a way of saying it. Whose career didn't it make on Wall Street? Maybe the short sellers didn't make their careers, but everyone had the benefit of what had heretofore been a rarest of gifts. I mean, a bull market lasting for 40 years. I say it as if it ended. I hypothesize it ended, bearing in mind the humility that we should all be preaching and living.
Yeah.
But usually I think in speculative markets you can observe in any hypothesized top or bottom, major top or bottom. One thing to look for is something that's extraordinary, almost incredible, right? So the approximately $18 trillion of securities yielding less than zero, to me, was the bookend, or more than the bookend, of long-dated treasuries yielding 15%. And then the retest of those heights in yield in 1984, when the CPI was printing at like 5%, and the long treasury was at 14. And you could have locked that in with zero coupon securities that would deliver you that. It makes you cry, doesn't it? Really hit that yield over the course. I think they were called within 5 years of maturity. It would give you 25 years worth of non-call protection at internally compounding rates of return of 14% or so from the U.S. government. And I'm here to tell you, Michael, that not everyone wanted to partake of that opportunity. They had been conditioned to expect the worst of the bond market. And here the bond market was saying, I'm sorry, but don't you want to try again?
Yeah.
Nope. We've had it with your certificates of company. We don't want no stinking bonds.
It's interesting because you talk about those in those long cycles, you do become conditioned to it. Because I vaguely remember I was a teenager in the 80s, and I remember my parents complaining about interest rates. But really, for my entire life that I've been paying attention to financial things, zero has been almost the norm, And so I think maybe, you talk about back then, people couldn't imagine zero. I think now it's hard for people to imagine 15. I feel like people kind of think zero is now the norm.
Yeah. Yeah, I'm not getting much traction on this idea of a secular bond market and bonds. I'm not trying to, I don't oversell it. I say this is pattern recognition. Mm-hmm. This is not some big dogmatic call. Although, Michael, if it works out, I'm going to say that I was as sure of it as the fact that next month is June. Right. But as it is a working hypothesis based upon nothing except pattern recognition and the aforementioned observation that at what may or may not prove to be the lows in 2020 and 21, I think in one of those 2 years, the 30-year Treasury was below 1%. And here, bear in mind, this was a time when the Fed was aiming for a 2% inflation rate and was just heartsick. It couldn't get the inflation rate to and the currencies were, of course, all paper, right? All paper, with a certain historical predilection for depreciation. And if you look back on it, it was such a setup. So I do believe that apart from pattern recognition, there are reasonable grounds to believe that we have seen the lows for that bull market for what may prove to be decades. And the bear move in bonds that began, call it in 2021 to 22, will be with us for a long time, and people take a long time adjusting to it. The bear market that began in 1946 began at, say, 2.25, again with reference to the long Treasury. And in 1956, 10 years later, that same security was yielding 3.25. So nothing that I've said about the presumed bear market that we're in, doesn't say much about the tempo. There was a terrific, of course, updraft in yields because they've been suppressed for so long. But what happens now is would 4.25 on the 10-year could it be with us in 5 or 10 years? Yeah, I guess. Although enter again here the question of the public credit of the United States and the notorious debt, which was not, after all, defeated, scarcely dead at its growth by Doge, which happens to be the name of a phony cryptocurrency.
Yeah. Well, I think it's interesting too. You know, we look at the just the recent stock market sell-off when we had the tariffs announced and then unannounced and then announced again. But it was interesting watching the bond market because it did initially kind of show that safe haven appeal. We saw yields drop in the early days of that, but even as the stock market was still falling, we saw yields suddenly rise. So it does kind of, in my view, at least give a little bit of anecdotal confirmation to the fact that we are in a different era for bonds than we were 5 years ago.
I agree with you, Michael. And there's a fair amount of academic observation over this very recent phenomenon. There's a couple of guys at NYU that have studied it, and others have taken a look at it. We at Grants have taken a look at it. And what was striking about the sell-off in April in stocks was that long duration treasuries, up to from 10 years on out, did not do their accustomed thing of declining as if to show that they were a port in a storm. Of course, the dollar itself, dollar exchange rate, sold off rather than proving its mettle as a place to go hide. So I take this. I have a few thoughts on this. I think many of us have heard about, if not read, a paper by an economist named Stephen Moran, who is now the President Trump's chairman of the Council of Economic Advisors. And Chairman Moran wrote, when he was a civilian, he wrote that he quoted somebody else, but he approvingly, he quoted him approvingly. We in journals know about that, how you can hide behind the revenue quote.
Yes.
But he quoted Voltan Pozar, very thoughtful and kind of edgy macroeconomist, saying that what the United States ought to do is exact a price for the services we deliver to our creditors. Well, what might they be? Well, we protect them against Russians and Chinese, maybe, and we allow them to sell in our beautiful market in the United States, right? And so what we ought to do, says now Chairman Moran, we ought to change the terms and conditions of the bonds that they hold. We ought to, if they're holding a 4% security, why shouldn't that be a 3% security? It would really help with America's P&L. Let's is the debt maturing in 5 years? How about if it matures in 100 years? A good thing. And there's something in the that's current in the world of private equity, and that is called a liability management exercise. How's that for euphemism? And an LME allows the strong to, I think the word is steal, from the weak and less lawyered up by exploiting legally permissible techniques that are implicit in the very loosely written loan documents. Mm-hmm. So the covenants these days that would formally protect the creditor through very tight lawyerly language, but past 5-10 years, the covenants have basically gone away. So you're talking about the ability of stronger, better placed creditors in a very predatory way to grab collateral that was not evidently theirs, and of companies in cahoots with these creditors to carve out special privileges and advantages for themselves at the expense of the weak and meek. If not meek, nobody's meek on Wall Street, but some are weak.
Right.
All right. So that's basically what my friend Mr. Posar was saying. He didn't call it, let's do a liability management exercise of the public debt. That's really what he's proposing. And that's what now Chairman Moran was approving in his way. And I saw just the other day, maybe it was on Tuesday, that Chairman Moran had kind of walked that back a little bit. But once you say something, you can't really unsay it. Once you say something, no, we're not really thinking about extending you in an involuntary way from 5 years to 100 years. Now, that was just a thought bubble,
Right. Yeah,
So,
if you wanted to have a bear market in treasuries, that seems like a good way to make one.
Yes. And so people are always, insofar as they pay attention to anything about this long-dated, they'll say, well, what's going to cause it? I say, I don't know, maybe more inflation. Well, how about the self-destruction of the public credit of the United States of America? That would do a little propelling of rates higher.
Yeah.
So this is, as you know, just listening to this somewhat disjointed narrative of mine, this is all very speculative. And nothing says that Donald Trump can't go back and read Alexander Hamilton's essay on the public credit and resolve that. As it happens, Michael, I happen to have on my very eyes right here the Congress's injunction to Alexander Hamilton when they directed him to write this essay on the public credit. Quote, that an adequate provision for the support of the public credit is a matter of high importance to the honor and prosperity of the United States. Mm-hmm. To the honor, prosperity of the United States. All right, so, and Hamilton did produce that report. And he said that the good faith is the basis of public credit. And this administration is so transactional, so brutal in its transactionalism, and so raw in the way it treats everyone, including its creditors. And I think there is some chance that these somewhat unappealing behaviors will come back and bite all of us. So again, this for what it's worth. That's my view of the risks so far as the bond market's concerned. Yeah, the Fed might cut rates, and we might have days like as we're speaking today when everything's up except you know what.
Yeah.
But I think that I'm going to. Do you have time for a baseball anecdote?
I would love a baseball anecdote. I'm a hockey player, but I'll take a baseball anecdote.
All right. Oh, you don't look like a hockey player. Your face, as I see, is entirely intact.
I'm a goalie. I have a nice helmet and mask. So
all your teeth are in. All right. So this has to do with Bob Gibson, the legendary, imperious, kind of scary pitcher for the old St. Louis Cardinals. Teams won so many games for the Cardinals. This is 1960 something, 30-game winner. Like 20 complete games. Mm-hmm. Wow. And there was an infielder named Ducky Schofield. Light hitting infield, very good glove, not so strong about. And one day, Ducky was up at bat, and as was his wont, he struck out. And Ducky kind of lost patience with himself and stalked back to the dugout, and with his bat began to have at the water cooler, cussed up a storm until he was summoned to the other end of the bench by the aforementioned imperious, scary Bob Gibson. And Bob Gibson points out to Ducky's batting average, 231. And he says, Ducky, what did you expect? What did you expect? All right, so in this country, we have a gross public debt in excess of 120% of GDP or something phantasmagoric figure. And we have a currency that can be conjured at the whim of the central bank in conjunction with the banking system. And we have a Congress that is even now trying to pull the wool over the eyes of the country with the phony baseline gimmick that will make it seem as if the borrowing is going to be within some arbitrary range. Anyway, it has to do with inside the beltway gimmick that the unchastened Treasury is unchastened Congress is now working to the advantage of those who would spend more money. So we have an unhinged spending habit, uncollateralized currency, and a president who, shall we say, whose principal excellence is not circumspection. And I think with all of this, if there is financial trouble of any kind, if there's or inflation, that's kind of financial trouble. If there's a wrinkle perceived in the American public credit standards of the United States public credit, we can't say we were surprised. That will not be a surprising thing. What did we expect, Michael? What did we expect?
Yeah. Well, I think that's a perfect way to wrap up this interview and let folks ponder that very question. But before I let you go, I do want you to let folks know where they can follow your work and perhaps.
Well, the first, if you type in Grant's into Mr. Google, the first thing you'll see is Grant's tomb. That's not us. Not yet.
Not yet. That's good.
But Grant's Interest Rate Observer will take you to our homepage. Grant's Interest Rate Observer will take you to our homepage, and I think we have a few subscriptions left. But there's plenty to read there without committing. Just to see what we have to say. If you like it, read more.
Get on your email list too. I'm on your email list, and you send out some good emails.
Yeah, and we have something that's FREE. And I can attest to its quality because it's written by my son Phil.
Well, I'm going to assume that it's of the highest quality then. Well, folks, do that. I really do, Jim. I really appreciate you taking the time out of your day. I know you're a very busy man, and it's been delightful talking to you. And anytime I can get a sports analogy, I'm a happy man. So I really appreciate it, and thank you very much.
Well, thank you for having me, Michael.
Great to finally have Jim Grant on the podcast, and I hope you enjoyed that interview. Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. Tune in as well to the Money Metals Midweek Memo, hosted by Mike Meharry and airing each Wednesday. To listen to any of our audio programs, just go to moneymetals.com/podcast or find that on whatever podcast platform you prefer. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865. Or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.